Dan is the director of behavioral finance for Betterment. So he's sort of our market psychologist whenever we have questions about behavioral psychology or behavioral investing. And Dan, just to summarize why you think all of this retail trading happened, I know you used the word entertainment investing, but you used the word more accessibility. The market is more accessible. And I think that's true. It's certainly easier to trade on your cell phone now than it was 11 or 12 years ago. Was there other factors involved? Did $0 commissions? Some people feel $0 commissions was a factor. Some people obviously feel just staying at home. Some people feel willingness of people to bet penny stocks. But, you know, I don't recall having the same frenzy in penny stocks in 2008 that we saw today. I'm trying to think if something is different now, or whether people are just naturally, who have a little money and are bored, willing to throw out, you know, a little risk money and play the field here.
I'd say there's one kind of like real amplifier that's the elephant in the room that we don't talk about as much, which is basically like social media and social networks. And there's a key thing here, which is that we don't tend to brag about the fact that we lost $15,000 last week, or we made a really bad mistake, or something went awry. When you talk to and hear from people, you know, like if you go on to forums like Reddit, where people are talking about how much money they made and how easy it was, we all tend to brag about how easy it is to beat the market. And there's a real sample bias in what most people are going to understand goes into that investing. And I think a lot of brokerages, a lot of places like are very happy putting out figures that reinforce the idea this is fun, it's fast, it's easy, you should be doing it too. But there's some real sample bias there. People can easily get the idea that this is really easy. I think there are some other interesting narratives out there right now that make you feel like a dummy in terms of the supportedness of policy. The idea, and I want to be clear, I'm not sort of endorsing this, but there are narratives out there that say, like, the Fed's going to come in and buy no matter what. They are not going to let companies actually go bankrupt. They are in such a sort of like protection point of view that you are a fool if you don't buy the companies that are losing in money. And amongst sort of novice retail investors, these narratives make you feel like it's an easy win for you to go in, trade a couple of like low value stocks that have recently fallen, and that you're guaranteed to make more money and beat the stock market and be able to brag to your friends about it.
Yeah, that makes a lot of sense to me. I mean, we saw this with Hertz. We were really scratching our heads trying to figure out, Hertz is in bankruptcy. Normally, a bankruptcy company, normally the common stock will be worthless. And when it's trading, the bonds were trading at 40 cents on the dollar. That tells you even the bondholders that are ahead of the common stockholders don't think they're going to be made whole at all. And yet the stock went from 40 cents to $2 really quickly. It's hard to like understand the psychology there, because it seems like investors either are day trading just in and out, or they don't quite understand the mechanism involved in bankruptcy. I mean, at what point does their cleverness become just ignorance?
Yeah, I mean, I think ignorance is a good way of putting it, in a very like benign way. Like when Zoom, the video conferencing company, was obviously going to do well because of all of the work from homeness, a different company who had a similar ticker was the one that was going through the roof. So I think there's a lot of shooting from the hip, a lot of people not really doing a lot of research and understanding even which company is which that contributes to this.
Yeah. John, you're our markets. Go ahead, John.
No, I think you also have to factor in that, you know, the Fed has anchored interest rates near 0%, so it's kind of forced people out the risk curve. So people, if they can't make any, you know, make any interest on their, you know, on their cash at the bank. I mean, I started my career in 1999. I remember tech stocks going up 1,000% in a year, but you know, Fed funds, you know, 2-year they were north of 5-6%, right? And that was risk-free, whereas now it's zero. So I think that's also a big catalyst to get a lot of people, you know, not, you know, taking their money out of the bank and going in the stock market.